Welcome to our summary of financial intelligence by Joe Knight, John Case, and Karen Berman. In this book, you'll discover how mastering financial intelligence can be a game changer for everyone in a company, not just the finance experts. Whether you're in management or working on the front lines, understanding the numbers behind your company's performance is key to making smarter decisions and driving success. Karen Berman and Joe Knight break down complex financial concepts in a way that anyone can grasp, empowering you to read financial statements, analyze data, and contribute more effectively to your organization's growth. The authors break financial intelligence into four main parts. The first is understanding financial measurement. This teaches the basics of financial statements, like income statements, balance sheets, and cash flow statements. It's important to know the difference between profit and cash and to understand how a balance sheet works. By learning these basics, you can start to see the true picture of a company's financial health. Next is the art of finance. The authors explain that finance isn't always simple. Numbers in financial reports often come from estimates and assumptions, which can change how we read the data. It's important to understand this because financial numbers aren't always exact. Judgments are made about what to report, when to report it, and how to classify different costs, which all affect the company's financial story. In the third part, financial analysis, the focus is on figuring out a company's financial health. Tools like financial ratios and ROI, return on investment analysis, can help uncover useful information. For example, these tools can show how well a company is using its assets, making profits, or managing its cash, all important for understanding how strong the company is financially. The last part is about seeing the big picture. Financial data shouldn't be looked at by itself. You need to understand it in the context of the economy, competition, regulations, and changing customer demands. When you put financial information in this larger context, you can make better decisions based on what's happening in the market and within the company. These four areas come together to help people at all levels improve their financial intelligence. The book simplifies finance and makes it easier to understand. By learning how to read financial reports, people can become more valuable at their companies, ask better questions, and use financial information to make smarter decisions. The Art of Finance section goes deeper into how financial reports can be subjective. The authors explain that financial numbers aren't always clear-cut and are often shaped by assumptions and estimates. Professionals make judgment calls that can affect the numbers. This doesn't mean the numbers are dishonest, it just shows that interpreting financial data isn't always straightforward. Managers should be aware of this and look closely at the numbers. By questioning the assumptions behind financial reports, they can get a better understanding and make smarter decisions. This process helps managers take control of their company's financial story and guide the company in the right direction. The book gives real-world examples to explain these ideas. One example is about revenue recognition. The authors talk about the Xerox scandal, where $6 billion in sales were recorded too early. This shows how companies can change sales numbers to make their financial performance look better than it really is. Another example is about capital expenditures versus operating expenses, where the WorldCom scandal shows how misclassifying expenses can make profits look bigger than they are. In the depreciation section, the authors discuss how companies like Waste Management used depreciation tricks to increase their earnings. And in valuation, they look at the risks of inflated valuations during the dot-com bubble, when companies were given unrealistic valuations. These examples show that financial intelligence goes beyond just knowing numbers. It's about understanding the subjective parts of financial reporting and using that knowledge to make better choices. The book also explains the income statement, which shows how a company is performing financially over a specific period, like a month, quarter, or year. The income statement lists a company's revenues and expenses and is often seen as a report card. It helps managers see how profitable the business is and make decisions that lead to better financial results. Financial intelligence ties these ideas together to give a clear understanding of finance. The book shows that financial literacy is important for everyone in a company. By understanding finance, people can make better decisions that help their company succeed. The income statement shows how much money a company makes and spends. It starts with revenue, which is the money earned from selling goods or services. Next, it subtracts the cost of goods sold, COGS, or cost of services, COS, which are the direct costs of making those products or services. The leftover amount is called gross profit, showing the company's basic earnings before other expenses are included. After that, the income statement lists operating expenses, like salaries, rent, and utilities, things the company needs to keep running. When these costs are taken away from the gross profit, what's left is called operating profit, or EBIT, earnings before interest and taxes. This shows how much money the company makes from its core business before taking taxes or interest into account. Finally, the net profit is calculated. This is the bottom line, showing the company's real profit after all costs, including taxes and interest, have been paid. The book also explains the matching principle. This rule makes sure that expenses are recorded in the same period as the revenue they helped create, giving a clearer picture of what it cost to make money during a certain time. The authors help readers learn how to read an income statement and understand its key parts. They explain the difference between an actual income statement, which shows real financial activity, and a pro forma statement, which adjusts for one-time events to give a clearer picture of ongoing performance. Knowing the difference between these statements is important. An actual income statement shows a true view of the company's performance, while a pro forma statement helps compare results over time by removing unusual events. The authors also say that managers need to understand the assumptions behind the numbers. By looking critically at these numbers, managers can make better decisions that align with the company's financial goals. It's not just about knowing the numbers, but understanding the bigger picture. This knowledge gives managers the confidence to lead their companies effectively. Next, the book discusses the balance sheet, which gives a snapshot of a company's financial health at a certain point in time. It shows what the company owns, assets, what it owes, liabilities, and the difference, owner's equity. The balance sheet is based on the equation assets equals sign. Liabilities plus owner's equity. This means everything the company owns is paid for, either by borrowing, liabilities, or by the owner's investments, equity. The balance sheet breaks assets and liabilities into short-term, current, and long-term categories. Assets include cash, inventory, property, and intangible things like intellectual property or goodwill. Liabilities are things like money owed to suppliers or long-term debt. Owner's equity shows what's left for the owners after all debts are paid, including profits reinvested into the company. And the authors explain how the balance sheet connects with the income statement. For example, profits or losses from the income statement affect the equity section of the balance sheet, showing how these two financial statements are related. The book also explains how assumptions and estimates affect the balance sheet. Just like the income statement, companies have to estimate the value of things like inventory or property. They also have to calculate the value of goodwill, which is the intangible value of a company that's been bought. Overall, the book shows that understanding the numbers on the balance sheet is important, but understanding the assumptions behind them is just as crucial. This helps managers make decisions that support the company's financial goals. By mastering the balance sheet, readers can get a clear understanding of their company's financial health and make smart decisions for long-term success. In the chapter Cash is King, the book talks about why cash flow is key to understanding a company's financial health. Profit is important, but it doesn't always give the full picture. Profit numbers can be influenced by accounting rules, while cash flow shows the actual money moving in and out of the company. This matters because a company might show a profit, but still have cash flow problems due to things like slow-paying customers or big upfront costs. The authors explain the cash flow statement, which breaks down cash activity into three parts: operating, investing, and financing activities. Operating activities show cash from the company's core work, like customer payments and paying for salaries and rent. Investing activities track cash spent on long-term assets, like property or equipment, as well as money earned from selling these assets. Financing activities cover cash raised and used for things like borrowing money, paying off loans, or giving dividends to shareholders. The book explains how to read the cash flow statement and how it connects to other financial statements. For example, net profit from the income statement is used to calculate operating cash flow, and changes in receivables and payables on the balance sheet affect overall cash flow. The authors also introduce free cash flow, which is the money left after subtracting capital expenses from operational cash flow. Free cash flow is important because it shows how much money the company has to reinvest, pay off debt, or give to shareholders. The book emphasizes that to fully understand a company's financial health, you need to look at both profit and cash flow. The cash flow statement gives a clear view of how efficiently a company is running and managing its money. Learning how to read it helps managers make better decisions and improve their company's financial strength. Next, the book talks about financial ratios, which are tools that help make financial data easier to understand. Ratios compare two numbers and give a clearer picture of how a company is doing. They help spot trends or problems that might not be obvious just by looking at financial statements. Financial ratios are not just about numbers. They show how healthy a company is. They let managers see how the company is doing over time, compare results with goals, and check how the company stacks up against others in the same industry. This helps find both strengths and weaknesses. The book explains 4 main types of financial ratios. Profitability ratios show how well a company turns sales, assets, or equity into profits. Leverage ratios measure how much debt the company uses and how well it can pay off that debt. Liquidity ratios show if the company can cover short-term debts, giving a sense of how stable the company is right now. Efficiency ratios look at how well the company uses its assets and controls costs to increase sales. The authors explain how to calculate these ratios, what they mean, and why they matter. They say it's important to track ratios over time, to spot trends, compare them to goals, and see how the company compares to industry standards. The book also shows how different ratios are connected, which helps give a full picture of a company's financial health. This part of the book helps managers look deeper into their company's financial data. By understanding and using these ratios, they can find key insights, see areas for improvement, and make smart decisions that help the company perform better. With this knowledge, financial statements become more than just numbers. They become tools for making better decisions. In the chapter called How to Calculate and Really Understand Return on Investment, the book explains how to figure out return on investment, ROI, which helps measure if a project or investment is worth the money. The authors start by explaining the time value of money, which means that money today is more valuable than the same amount in the future because you can invest it and earn more. This is important when making investment decisions because things like interest rates and inflation can affect how much money is worth over time. The book explains 3 key parts of ROI. Future value is how much you expect your investment to be worth in the future, based on how much it grows. This is often used in retirement planning or predicting how stocks will grow. Present value is the current value of future cash flows, adjusted to today's value using an interest rate. This helps compare what you're investing now with what you expect to gain later. Required rate of return is the minimum return you want from an investment, considering other investment options and the costs of borrowing money or using the company's own funds. The authors describe 3 ways to calculate ROI. The payback method shows how long it will take to earn back the money you put into an investment, but it doesn't factor in the time value of money or any extra cash earned after the payback period. The net present value, NPV method, adjusts future cash flows to their present value using the required rate of return, then subtracts the original investment. If the NPV is positive, the investment is likely a good one. The internal rate of return, IRR method, calculates the discount rate that makes the NPV of all cash flows equal 0, helping you see if the investment is worth it based on whether the IRR is higher than the required rate of return. Each method has its pros and cons, but the authors usually suggest using the NPV method when the results of the other methods don't agree. They also stress the importance of having accurate estimates for future cash flows, costs, and discount rates. This chapter gives practical tools for calculating ROI. It explains why the time value of money matters, how to use different ROI methods, and how financial projections can sometimes be uncertain. By understanding these tools, managers can make better investment decisions that help their companies grow. This turns financial statements into more than just numbers. They become tools for making smart decisions. In the next chapter, Applied Financial Intelligence Working Capital Management, the book focuses on managing a company's working capital, which is the money used for day-to-day operations. Working capital is the difference between current assets, things that can be turned into cash within a year, and current liabilities, debts that must be paid within a year. The goal of managing working capital is to make sure the company has enough liquid assets to cover short-term debts without holding too much cash or resources that aren't being used. The authors explain the main parts of working capital. Cash is the most liquid asset and is needed for paying bills, salaries, and buying materials. It gives the company flexibility to handle business opportunities or problems as they come up. Inventory includes everything from raw materials to finished products. Good inventory management is important. Too much inventory ties up cash, and too little can lead to missed sales. Receivables are the money owed by customers for goods or services they've already received. Managing receivables well makes sure the company gets paid on time and avoids bad debts. Payables are what the company owes to suppliers. Managing payables carefully keeps good relationships with suppliers and helps the company's cash flow stay healthy. The book introduces the cash conversion cycle, which measures how well a company turns inventory and receivables into cash and pays off its suppliers. A shorter cash conversion cycle means the company is managing its working capital well, turning assets into cash quickly and reducing the need to borrow money. This chapter gives helpful advice on managing working capital, helping companies keep enough cash to run smoothly while staying flexible for future growth. The book also gives strategies for improving key parts of working capital. One way is to collect money from customers faster. This can be done by improving customer relationships, offering discounts for early payments, or making credit terms stricter. These actions help bring in cash more quickly, which boosts cash flow. Another strategy is better inventory management using methods like just-in-time inventory. This cuts down on the cost of holding too much stock. There's also a strategy to delay payments to suppliers, which can help the company hold on to more cash for longer, but it's important not to hurt relationships with suppliers, as this could cause supply chain problems. By improving these areas, companies can shorten their cash flow cycle, leaving more cash to invest in growth, pay off debt, or distribute as dividends. The book emphasizes that managing working capital isn't just the job of the finance team. Every manager plays a role because their decisions can affect the company's cash flow and financial health. Each department contributes to making sure the company stays financially stable. In the 9th chapter, called Creating a Financially Intelligent Department and Organization, the book shifts from personal financial knowledge to teaching finance across the whole company. The authors say that when everyone in the company understands basic finance, it benefits both employees and the business itself. This creates a culture where everyone grows together. For individuals, understanding finance helps them see how well the company is doing, which can help them make better career decisions. It also helps them understand why certain financial decisions are made, building more trust in the company. Financially knowledgeable employees can make better decisions in their daily work, which leads to better job performance and career growth. The authors explain that this knowledge not only makes employees better at their jobs, but also more engaged in the company's success. For companies, having employees who understand finance makes the organization stronger. When employees know how their actions affect the company's finances, they make better decisions that support the company's goals. This shared understanding builds trust, reduces confusion, and helps people work together more effectively. The book provides examples of companies that saw big improvements by teaching their employees about finance. The authors suggest ways to teach finance in the workplace. One idea is to offer training programs for specific roles, so employees learn the financial parts of their job. These sessions should be interactive to keep employees engaged. Another idea is to hold regular meetings to talk about important financial numbers and show how employees' work affects the company's finances. This encourages accountability and ownership. The authors also recommend using visual tools, like charts or scoreboards, to track financial progress. These tools make the numbers easier to understand and more meaningful for employees. The book emphasizes the need for a culture where financial information is shared openly throughout the company. When everyone has access to financial information, it builds trust, encourages teamwork, and helps employees make decisions that align with the company's financial goals. Companies that create this kind of culture are more likely to succeed because everyone is working toward the same objectives. In the final part of this chapter, the authors talk about how financial literacy can have a big impact on both employees and the company. They provide practical steps to build a financially smart workplace, like regular training, clear communication, and transparency. By creating an environment where financial knowledge is valued, companies can empower their employees, improve decision-making, and set themselves up for long-term success. In the conclusion, the authors pull together the key points from earlier chapters to show how financial intelligence can make a big difference for both individuals and businesses. They explain that learning about finance isn't something you do once and forget. Instead, it's something you keep learning and using throughout your career. The real value of financial knowledge is using it to make better decisions, improve work performance, and help the company succeed. The authors describe how financial literacy helps people make smarter decisions, perform better in their jobs, and even find new career opportunities. For teams, understanding finance means making better choices that align with the company's goals. When departments understand the company's financial situation, they can work more efficiently and effectively. The book also explains how a company that encourages financial understanding builds trust and teamwork among employees. This leads to better financial results and long-term success. The authors end with a strong message. Financial intelligence isn't just a skill, it's a powerful tool for success at every level of a business. They make it clear that understanding finance is key to building a company where both people and the organization can thrive. If you liked this summary, please like, comment, and subscribe to our channel. Your support helps us bring you more useful book summaries and practical advice. Stay tuned for more content to help you achieve your financial goals and grow personally. Thanks for watching.